Your savings account feels safe, but something invisible is stealing from you every day. I used to sleep soundly knowing my money sat in a federally insured account. Then I learned about inflation, and everything changed. Inflation is the silent tax nobody voted for. 3% inflation sounds harmless until you do the math. At 3%, your $100 becomes $97 in purchasing power. Year 2, $94.09 of real value. By year 10, that $100 buys only $74 worth of groceries. Meanwhile, your bank statement still shows $100. The numbers lie. The purchasing power tells the truth. I walked into my bank and asked what interest they paid. 0.5%. Less than 1% on my life savings. My grandfather earned 5% in 1995. That world is gone. Today's savings rates are a historical anomaly, not a permanent feature. The Federal Reserve sets benchmark rates near zero for years. Banks pass almost nothing to savers. They profit from the spread. Your deposit becomes their cheap funding source. They lend your money at 6% while paying you 0.5%. That spread is their business model. Your stagnation is their profit. But inflation marches on, regardless of what banks pay. Housing costs rose 20% in some cities last year alone. Eggs, milk, gasoline. The basics keep climbing. Your fixed savings number buys less and less of this rising world. Economists call this negative real yield. I call it guaranteed loss, dressed in the costume of safety. The FDIC insurance protects against bank failure, not purchasing power erosion. Your account won't go to zero. It will go to worthless. Compound interest works both directions. Inflation compounds your losses too. 2% inflation for 20 years halves your money's value. 3% inflation destroys it faster than most people imagine. The 1970s saw double-digit inflation. Savings accounts were obliterated. Today's 8% inflation in 2022 did visible damage. Even at the Fed's 2% target, you lose with 0.5 savings. The gap between inflation and your return is your annual loss. At 4% inflation, the 2022 many of us lived through, that gap becomes 3.5% annual loss on everything you saved. Every year. Guaranteed. By design of the system we inhabit. I asked my parents why they saved so aggressively in the 1980s. Certificates of deposit paid 12%. Savings felt powerful then. Those rates created a culture of saving that no longer makes mathematical sense. Yet the advice persists. Save your money, be responsible, delay gratification. Good advice in 1985. Dangerous advice in a negative real rate world. The responsible move today requires understanding where value actually flows. Corporations borrow cheaply from suppressed rates and buy back their own stock. Asset owners get richer while cash holders quietly fall behind. The wealth gap isn't accidental. It's engineered by monetary policy choices. Your savings account is a polite invitation to participate in your own decline. I moved my emergency fund to a high-yield savings account first. 4% instead of 0.5%. Same FDIC protection. Online banks without physical branches pass savings to depositors. The difference compounds meaningfully over emergency fund timeframes. Most workers saw wages rise 3% in 2022, still trailing inflation, forcing them to burn savings just to maintain their standard of living. I started tracking my own savings against rising grocery prices each month. My apartment rent jumped 12% at renewal, a single line item that consumed 6 months of supposed savings growth in one stroke. The bank never calls to warn you that your emergency fund is being quietly consumed by forces outside their walls. This is the illusion that traps millions of careful savers. The balance looks correct. The reality underneath has shifted. Psychologists call this loss aversion. We feel the pain of a possible market drop more intensely than the guaranteed erosion of inflation. We evolved to notice predators, not percentage point erosion. Our brains see stability and relax, exactly when vigilance matters most. Banks understand this psychology and design their marketing accordingly. They emphasize security, FDIC protection, and peace of mind. These promises are real, but they are not the complete picture. Security without growth is simply a slower form of loss. I needed to understand what alternatives actually existed. Treasury bonds, money market funds, and index funds entered my research. Each carried different risks. Different liquidity constraints, different learning curves. The emergency fund could not be gambled, I knew that much. 6 months of expenses sat untouched in that savings account still. But beyond that safety net, money was bleeding value monthly. I began with Treasury inflation-protected securities, called TIPS. These adjust their principal directly with the Consumer Price Index. When inflation rises, the TIPS value rises with it automatically. The trade-off is lower initial yield and some tax complexity. For pure liquidity, money market funds offered slightly better returns. These invest in short-term government and corporate debt instruments. They are not FDIC insured, though they have historically been stable. I learned that breaking even with inflation is actually an achievement. Most savers fail even this modest goal year after year. Healthcare costs rose 5.4% annually for 2 decades, a separate inflation that hits hardest when savings matter most in old age. A 30-year-old putting $10,000 aside for retirement faces this directly. By age 65, that purchasing power might halve without protection. The numbers on the screen would still say 10,000 cruelly. I realize my parents' generation faced this same quiet crisis. The solutions were harder to access then, information moved slower. Today, opening a brokerage account takes under 10 minutes online. The barriers are psychological now, not technological or financial. Fear of complexity keeps people in familiar losing positions. I decided to move half my non-emergency savings into index funds. These track entire markets rather than betting on individual companies. The historical average return exceeds inflation significantly over long periods. Of course, some years the market drops 20% or more. That volatility is the price of beating inflation over time. I had to accept that my money would not always grow smoothly. Retirees face sequence risk. A market drop in year 1 of withdrawals causes permanent damage that smooth savings never recover from either. Between these extremes, I found a place for bond index funds too. These fluctuate less than stocks, while generally outpacing savings accounts. I built a simple 3-fund portfolio for my extra savings. Total stock market, total bond market, and international index together. Rebalancing once yearly keeps the risk allocation where I want it. This approach is not exciting, and that is precisely the point. Wealth preservation should be boring. Speculation is what destroys. I still check my accounts, but the emotional tone changed completely. Before, I feared looking. Now I understand what I see. The knowledge transformed anxiety into measured, appropriate concern. I could finally distinguish between normal fluctuation and genuine problems. This literacy is arguably more valuable than any single investment return. The official inflation measure assumes you will substitute cheaper goods when prices rise, masking how your actual life becomes more expensive. Hedonic adjustments claim your phone is cheaper because it has more features, even when the price tag grew larger at the store. These statistical blind spots mean your personal inflation likely exceeds the headline number by a full percentage point or more. Some losses hide in plain sight, disguised as loyalty programs and rewards. Those airline miles won't buy groceries when shelves go empty. I calculated what my grandmother's 1970s savings would fetch today. Her $10,000 then equals $65,000 now in purchasing power. Yet the bank statement still reads $10,000, as if nothing changed. This is the arithmetic of erosion, slow, impatient, and cruel. We have been taught to fear market crashes more than this quiet decay. But the crash recovers. Inflation's damage compounds irreversibly. What would honest banking look like if banks disclosed real returns? Imagine statements that subtracted inflation before showing your progress. That single line would transform how millions see their so-called security. I no longer keep my emergency fund in places that punish my patience. The new account yields 4%, still below inflation, but closer to honest. Every percentage point closer to inflation is a smaller surrender. I keep 3 months of expenses accessible, the rest working harder. This balance between security and growth took years of costly mistakes. Ask yourself what your savings will actually purchase in the decade ahead, then choose your path with eyes open to the arithmetic that governs it.